And I'll just go back to, what are the consequences?
Closer.
Sorry. Usually I'm pretty loud, so what are the consequences when rates are arguably too high? There's a rebate, there's a public vetting, you look bad, it's a bad reputational thing to be sending checks back to your customers. That's about it. And you lose members, and you're less competitive. And nobody sits around this table, Dave and I don't sit around our tables and say, how do we lose members? Right? So we are very in tune to the efficiency of the market. Flip that, what are the consequences when rates are substantially too low? You sit around a table like this and you talk about the demise of one of your competitors, and that's not healthy for anybody. It hurts the industry. Believe it or not, we want competition. It makes us better. It makes us more efficient. It makes us innovative. It requires us to build products and services that are valued by consumers. And quite frankly, our relationship with the department, I think, has been terrific over the years in the sense of we've worked together in a lot of ways to talk about those things, innovation, the types of things that are going on in the marketplace. It seems to break down during the rate filing process, and that's just because of lack of either transparency or just the timing of getting rates and information back. So even when you disagree with what ultimately you get as a rate, there doesn't seem to be that functional 2-week period, 3-week period to sit and debate and talk about why the rates are deficient. I'll give you one example. Our rates were adjusted down this year for 1/1/16 based on an anticipated risk adjustment payment that we're supposed to receive from the marketplace. Well, the biggest payer in the marketplace for the risk adjustment is Health Republic. Based on everything that Dr. Maldonado and Jeff talked about and Kathy, no one's expecting any of those dollars to flow back. So my sense is Dave and I have rates that are substantially too low based on risk adjustment payments not being paid. I'm using that as an example of the marketplace is very efficient, and it's a very challenging thing. I would have loved to sat in a room and said, what's your confidence level that these risk adjustment payments would have been paid? Quite frankly, I think if we would have had that opportunity in July and August, based on the information that Troy just talked about, he would have said, we're not as confident as we probably should be.
I would agree the word murky has been mentioned here, and I think very appropriately, and I think to try to get rid of the murkiness, I think every one of the senators at the table here last June supported a bill that I sponsored, 4540, which would have, if enacted by the Assembly and signed by the governor, would have, I think, created a great deal more transparency in the rate setting process, the prior approval process, kind of get the process out from behind the curtain, out into the sunshine of day, and to see what, rather than just saying, well, we based our decisions on sound actuarial principles, just what are they, and have them out in the open, and also give an opportunity for plans to respond to what the department has done in a formal way, and then get a response back from the department, all of what we're talking about here today. I think there are even those, I know the Empire Center issued a report just recently saying maybe we'd be better off just repealing prior approval entirely, going back to what had been in place.
We would be okay with that. But
I assume that. In terms of, if you take a look at the actual rates here in New York versus the national trends, would be in line. So anyway, certainly, we're, for starters, in terms of next steps, we intend to pursue our transparency bill again this year. And I think it's more important than ever in light of what we've seen with the Health Republic experience. And as you point out, some of the rates that were set for 16 for some of the plans are based on perhaps some revenues that will not be there for you. And so obviously, we want to have the lowest possible rates in New York State when it comes to health insurance. But when your insurance isn't there when you need it, what good is that for the consumer? And to have a multitude of choices by attracting more players into the market, all that is good for the consumer as well.
Mr. Doolin.
Sure.
And it occurs to me that not only we're talking transparency, but what you said, and I'm experienced with the prior approval law, is the calendar of this whole process seems to be truncated and not necessarily the best.
Yeah, absolutely. At the risk of being somewhat contrarian, I frankly don't think the issue is transparency. You know, codifying in a statute is nice and comforting, but I think the department is incredibly transparent on a plan-by-plan basis with how they determine the rate. The issue, frankly, is the subjectivity. When you disagree over amounts to be received on risk adjustment, when you disagree on basic actuarial determinations such as what is trend, and you see a press release, frankly, you know, year over year that says medical trend is 7%, however, we're approving rates on average that are 4%, well, something doesn't add up. And it's that subjectivity, really, that is the root cause of the problem.
Well, that's part of the transparency, that you're either going to have your actuaries compare what's taking place in the marketplace and having adjustments accordingly, and whether or not those adjustments are taking place and whether they jeopardize reserves of the insurance company. But I'm not so sure we're differing in adjectives, but I'm not sure we're differing in subject.
Yeah, my point is only the disclosure, making it public, certainly is helpful. I think it takes place on a case-by-case basis and interviewing with the plans. But at the end of the day, if they have unbridled discretion, the transparency only goes so far.
Yeah. So you would go for modifying prior approval?
Putting in some objective standards and protecting against abuses that may have occurred under file and use.
Well, you want to answer this?
Well,
Into the mic.
yeah, we support, as I indicated, you know, a repeal of prior approval. And I think Bill Golden raised the issue of using the MLR, which is something we had talked about originally as an objective standard that could be defined and could be utilized, and we would all understand it.
For the record, Paul, what is MLR?
Medical loss ratio.
And how does that computed?
That is computed on in terms of accepted expenses for claims, and it's your premium towards your medical expense versus your admin and your profit, et cetera. And you define, and we have in statute, as Bill pointed out, an 82% MLR. That means 82% of every premium dollar has got to be spent on medical care. And that acts as a restraint on plans in terms of the rates, in terms of admin, profit, et cetera, in terms of excessive rates. And we have an 82% in the small group, 85% in large group. And it goes to what Sean said as well, because the MLR would help the department, because it would also, in cases where rates increases are needed, if a plan wants to be a predatory pricer, come in and buy market share and comes in with artificially low rates, somebody's got to say that rate's not sustainable, you're just trying to come in and steal market, and you need a higher rate to have a solvent, stable market. And an MLR, if it showed that somebody was spending more money on care than they were taking in, that's clearly a cause for an increase in the rate. We saw in a couple of other states, Oregon and Florida, two examples where their insurance superintendents forced plans to raise rates because he was concerned about solvency.
So it's the insurer regulator forced plans to raise rates?
Yes. Because he was concerned about stability in the marketplace. And here in New York, and for my 2 minutes here, I mean, it got to the fact that DFS today has the two goals. One is, I'll say, to squeeze down rates, to come in with the low rate, and the second is to maintain the solvency of plans. Health Republic, they were absorbing losses. People knew they were in really bad shape. They needed not rate cuts, they needed rate increases. DFS took a position. They put it in the consumer bulletin on Health Republic, and they said, in no case would DFS approve a rate above that requested by the plan. So they basically threw out or gave away the tool of increasing rates to maintain solvency in favor of squeezing down rates. And that is a part of the subjective problem with the unfettered discretion that exists today in prior approval.
Is the same thing going to happen when you have to absorb losses you didn't expect to absorb when you're not getting paid by Health Republic now for your rates? Bill?
Well, I mean, it's a challenge for us because even though I work for a national organization, we run very much, state by state, and that's how we're determined on where we make investments and how we operate our businesses. So I'm sure we'll weather the storm, but yeah, it does impact our concern regarding, the ongoing either working with the exchanges. I mean, if those rates are not supported, it's a tough message to say that we're going to be in a marketplace, but we're going to lose money, or we're going to expect to lose money because there's an unpredictable premium payment. So that is a tough message internally. Dave has a different issue. He's a local regional plan, and his issues will be more challenging, but we still look at those same decision processes and say, is this a supportable marketplace? Is it something that we should make investments in? And can we be in it for the long term if it's not going to be sustainable?
Don't hold back, Dave.
I usually don't. About 20% of our business is related to the rate-setting process, so it's significant. And if that business doesn't make sense, then as a nonprofit health plan who doesn't have retained earnings, we don't have downstream subsidiaries, we can't go to other regions, then those rates have to be accurate for us to be sustainable. In the transparency issue, I think, would help, but we would be in favor of actual using an MLR standard as Paul had identified, because we do think it's duplicative. And we could agree, potentially say, if in fact you don't hit that standard, if for some reason you're in a year or two or some period of time, your margins are better than what that MLR standard calls for, then there could be a different type of interaction with the department to make sure that that's brought back in line. But just for reference, most of the regional health plans in the state run a medical loss ratio in the high 80s, close to 90%. So we're in a rate-setting approval. What problem is that trying to solve in this state with the plans that we have? It seems unnecessary, and also it has not been transparent to the degree that we would like, that what we submit does not come back in the same form. I'm not going to say that nothing comes back, but not in the same way. And we acknowledge that two actuaries would look at a rate filing. They wouldn't come to exactly the same conclusion all the time, but they wouldn't be 30% different either.
Yeah.
And that kind of interaction with the department would actually help us and make us better in our submissions, and would give us additional information on our own rate setting process. So I actually think it would be helpful.
Going to do a lightning round, which means that this is the most difficult part, because I want you to finish off with what you want to say if you haven't said it before. Don't want you to repeat. But let's see how we can do. It's been very enlightening. It's been very conducive. And we'll start off with Dr. Montaltalvo.
Sure. First of all, I think that sometimes an MBA is useful, and I think this is one of those instances. In MBA school, I learned that in terms of transparency, you don't always need transparency. What someone shows you is not necessarily what you want to see. What you want to see is what they don't show you. Okay, so transparency, I'm not quite sure what the value of it is. In terms of major projects...
I thought you were talking about surgeons.
The results speak for themselves. But in terms of major projects, which I look at this healthcare transformation to be, the reason for failures, the evidence shows, is number one, optimism bias and strategic misrepresentation. And perhaps that's where the murkiness that you are talking about, and if you'd like, I'd be happy to tell you a little bit more about that at some other time. But regardless of all of these issues in terms of the rate setting, the facts remain that the physicians and providers in the state of New York are out millions of dollars. And right now, you're in the process of delivering the biggest transformation in the state of New York. And if you cannot make physicians whole, and really this is where I think you need to focus, if you cannot address this problem, you're going to have a major problem in terms of being able to bring forth the healthcare reform that you're looking to bring, because there is no confidence in the system, no confidence in the state, if we cannot be able to say we stand behind you as we go forward through these murky waters of transformation. So you've got to come up with a guarantee or a special fund to address this, restore the confidence of providers in the state of New York, and we can move forward with the transformation that needs to occur.
Thank you. Mr. Gold?
Yeah, I think net, there's three things on the table. The first is the rate setting process flawed or not flawed, and I think the plans have addressed that at some length. The second is, does oversight clearly need to be tighter, particularly when you have a theoretically flawed model? Can't infuse cash based on federal loans. Do you have to ride that thing on a much tighter leash because it's self-evident that something's going to happen, particularly if they're not at market prices? The third is, okay, do you do all that, and some plan will still fail anyway, somehow? And if that happens, even if you've done the other things right, there needs to be a remedy. You can't expect the provider community, particularly given margins that exist for hospitals, et cetera, to absorb $200 million in losses and shake it off. And there needs to be either a bailout or a fund or some other state-driven mechanism, at least to solve this one, and hopefully to solve those that pop up in the future. But it's three. It's rate setting, it's oversight tighter, and it's, okay, what's the fund or remedy that's going to be there as in other states? Thank you.
Thank you. Mr. Maslach?
Just want to spend a minute on the guarantee fund. And very briefly, Kathy mentioned how 48 states have it. Well, if we want to be like 48 other states, do away with the HICRA taxes, because they don't have them. And that is a 5% share of premiums today is just to pay HICRA taxes. Get rid of them. Make us like the 49 other states, and then we'll sit and talk about a guarantee fund. But the problem with the guarantee fund, as we sit here, it's almost like a get-out-of-jail card for DFS. DFS has that balance of trying to squeeze down rates while maintaining solvency. Well, there's, as we've heard all around the table, this pressure to drive down rates, is an overwhelming pressure, and that has been a policy that they follow. If you create a guarantee fund, it's just more incentive to try and drive down rates, because that's the release valve. That becomes the backup. There's going to be a guarantee fund if they screw up and make a mistake. The final point is, I think you need to look at the money that exists in the state from various settlements that's been pouring in. This state has collected billions of dollars in settlements. And the governor, in his financial plan and some of the material out, has made a point that those are one-shots. One-shot money coming in, and it's to be spent for one-shot uses going out. This is a great example of a one-shot. The Health Republic need to pay providers, et cetera. And we suggest you look at that as a pool. We've looked at last year's payments out. Hospitals got $400 million out of that, those settlement monies for different transformation uses. We believe out of monies coming in today, out of the more recent tobacco settlement, there's another, pot that's coming into New York. We think that's where you ought to look to pay providers in this case.
Thank you. Mr. Iselin?
So what are the takeaways from our discussion? First, and most importantly, if we get it wrong, we will crash the exchange, and we need to be blunt about it. Plans won't participate, consumers won't have choices, and we will have much bigger problems. So we need to be thoughtful and measured in how we think about responding to Health Republic, and more importantly, on the structural reforms that are needed to the prior approval and oversight processes. Second, we need a remedy for what happened, a short-term remedy for what happened with Health Republic. And we all agree, we've all been injured, all sectors have been injured. But the short-term remedy cannot be a tax on consumers. That is the worst possible remedy you could choose. Third, we need a long-term remedy, maybe. But the long-term remedy, again, has to be this discussion of many things: rate adequacy, oversight, et cetera. Let's not push together the short-term and the long-term because they're two very different problems.
Thank you. Dr. Hayworth.
I would like to add on to Mr. Gold and Dr. Maldonado, and I think if you want physicians and hospitals to participate in all the change and all the transformation going forward, what we hear, speaking to the people in the grassroots, the people in the trenches doing the work, is that they're not going to participate unless there is a solution for Health Republic. Also, with the legislative session starting today, it's a 6-month session, will we see a solution soon, and what's our takeaway, and where do we go after today?
Yeah. Mr. Anderson.
I think just a couple of things. I think one of the things we've talked a lot about rates, but one of the things we do as a health plan, when rates are not adequate or below costs, we have to lower our costs, which means we have to drive down our reimbursements to physicians and to our hospitals. It doesn't stop with just a rate-setting process. That's actually the start of a process of funding health care within our system. And we have a primary care shortage in many of our communities around the state. And part of the reason is because it's not very attractive for a primary care physician. They don't make enough money to pay off their medical school loans. So these issues are connected. It isn't just a rate-setting process. It has to be viable throughout the system in a way that allows everyone to be compensated and paid fairly. The other thing I would say is the process itself. I want to emphasize the importance of the process of reforming the process of regulation, because as difficult as this is for all of us, Health Republic is a relatively small regional health plan. They are 1/5 our size. They're less than that for Bill's plan. In regional plans around the state, the next one could be much larger if we don't fix the issues that we've talked about today.
I'm going to come back to you guys.
Can I just add one quick thing?
Sure.
This is really affecting our ability to recruit primary care physicians to the state. And I think you brought up a key point, that if we want to keep physicians in the state, I'm having trouble, 425 doctor group recruiting physicians. And if we want to continue to recruit the best and the brightest of this state, we need to take care of this problem. And if we don't, you're going to see a fleeing physicians out of the state, and it's going to be hard to recruit. Thank you.
Thank you. Craig?
Thank you, Senator. 3 points. I think we need to increase scrutiny of reserves, but we need to reduce regulation so we can create an environment to stabilize participation by established insurance carriers. The second point is a guarantee fund is going to increase rates. And I have to tell you, I deal with employers every single day. We've reached a tipping point. Anything that increases rates is a tough sell from our perspective. And really, when we look at the decision about whether to locate in New York State and do business or locate across the river in another state, it's becoming an easier decision as we look at healthcare rates in this state. The third point is that we need to help consumers better understand health insurance. Right now, it's simply a price purchase. Consumers need to understand health insurance better, and it's simply too confusing. Thank you.
Thank you. Mr. Doolin?
Bouncing around here, it threw me off.
No, I'm going by where you're seated.
So I think that the primary focus here should be looking forward to ensure that the Health Republic demise can be prevented in the future. There are tools in the department's statutory and regulatory war chest today, whether it's risk-based capital, which most other states have, and requiring oversight of risk-based capital. There's a statutory reserve requirement in the insurance law, Section 4310, that the department has obligations to ensure that each plan is above that. And virtually no other state has both of those solvency requirements, unlike the guarantee fund. Those preventative steps, combined with looking at other initiatives to ensure that the job the department did this year, which is incredibly commendable, moving quickly, can be done a year ahead of time. It's to your phrase, the canary in the coal mine. If this was detected a year ago, we wouldn't be here today. The steps would have been taken by the department, both departments, health and insurance, as well as Health Republic and the marketplace to address those issues.
Thank you. Mr. Golden?
Yeah, so it's hard not to be duplicative of a lot of the things that we've talked about, but I'll just reiterate a couple of things. Number one, we are always concerned that rate processing and approval for rates takes on a political tone. And we just, on a go-forward basis, there has to be some level of transparency and predictability about what the process is and how we go about it. I would submit, though, for everybody sitting around this table, affordability is obviously key for us. It's key for the providers, it's key for the plans. We haven't really talked about some of the upside if we were just to use an MLR basis for approval of rates. I think what you would find are some commercial carriers would be interested in providing products and developing networks within the state. I do believe it would allow some commercial carriers to expand new products and take some chances, and knowing that they have an MLR standard, rather than you are successful, you do provide a rate that is competitive yet attractive in the marketplace, but that if you're overly smart about how you do it, you have a possibility that you cannot get the rate that you need to sustain it. So I think there's some upside to either reforming the prior approval or just going to the MLR standard that we really haven't talked about. I think it would free carriers to participate in upstate or downstate, to allow new products to flow into the market. I think there's been a pattern down of those types of opportunities because of the unpredictability of the process.
That's intriguing, especially in light of the new debate on narrow networks. Sorry, Kathy Shore.
I think that there's no question that we need a premium process that results in rates that cover the cost of providing medical care. And it's appropriate at this time that we look at whether what we have in place is functioning the way it was intended. So I think we should all be looking at that. But we do need a short-term solution and we need a long-term solution. They could be one solution or they could be two separate solutions. But the long-term solution can't be that maybe the government will come with some money to throw at the problem. We need to have a solution that provides providers in advance comfort that they will be paid in the end. Otherwise, we end up with the mess that we had this time trying to figure it all out in 5 weeks' time frame.
Okay. Now, Donna, you've managed to remain remarkably solid. Congratulations.
So first, 2 points. First, something Harold said at the outset and others said as well, that as we look at potential policy changes going forward based on the Health Republic circumstances, that we bear in mind, we've talked a lot about the rate setting process, we bear in mind the other inherent issues in the co-op model that have caused trouble not only here in New York, but across the nation. And then secondly, I think I'm going to assume a little bit maybe of a consumer role here, if that's okay, and say that as we look at any policy changes going forward, that I think that we all would just, I would encourage you to bear in mind that the system works best for everyone around this table when people have coverage. And part of the success we've had collectively in dropping our rate of uninsured in New York to less than 6%, non-elderly, for the first time in decades, based on information released as of June 2015 by the CDC, is because we collectively successfully made coverage more affordable for consumers. And I think ultimately that's the policy objective.
Thank you. Troy, and I'm not going to say this, but you do actually have the last word.
He always does.
Yeah, just be able to talk to my daughter. She wouldn't say that. I would say that, first of all, to make clear, as we haven't said this before, that solvency is absolutely at the core of what we do at the department. It's, for anybody who follows Star Trek, it's like our prime directive. I mean, solvency is because it's the most fundamental consumer protection. Consumers expect they're paying good money for premiums. They want that coverage to be there for them, and so we do take it very seriously. And in Health Republic, and I won't go over it again, but we felt like we really monitored it. When we saw there was a serious problem, we acted
promptly and made a tough call to shut them down, even though the company itself was reporting itself as solvent. I just wanted to mention sort of about the comments on prior approval. Mr. Anderson, the health plans are sort of noting, he said that the prior approval is unnecessary and that actuaries wouldn't be 30% different. But the reality is that actuaries were 30% different from their own filings, had them at different rates. And it seems to be like what Paul was suggesting with Oregon. The department should be saving the plans from themselves and ordering that their rates be higher, even if they are actuarially supported and justified. And I would just note that in Oregon, they did increase the co-ops rates, but Oregon is one of the failed co-ops that went down. And the point really is that this is bigger. The problems that we talked about with the federal co-op program being underfunded, the risk corridor programs having funded taking away, were all things that happened after those initial rates were approved and really contributed to a wave of co-ops going down around the country. Going forward, and we just haven't mentioned that, we know that we recognize that there's been losses by providers, certainly, health plans and brokers, and we know there's going to be a robust dialogue around what to do about that, and we're eager to participate in that dialogue.
Comments? Senator Little, Senator Golden. Senator Golden's first meeting I've ever been with him, he hasn't said anything.
I think it's very important that I thank both of the chairs for this great dialogue that we're having here today. There's obviously need for change, there's need for legislation, there's need for openness, and I believe that we're stepping in the right direction. So I thank our both Chair Sewitt and Chair Hannan, and of course all of the industry for being here today, and of course the state, the DFS and Health for being part of this roundtable. I do believe you will get some reaction from the Senate, and I believe that Senator Hannan and Senator Jim Stewart and our committees will take this very seriously and put out some real legislation that I believe helps not only the state, but helps the industry across the board. Thank you.
Senator Little.
Thank you very much, and I just want to thank everyone who's participated in this roundtable today for not beating around the bushes. It seems like everyone was very honest and straightforward in what they felt was the problem and the existing issue. I represent 6 counties in the northeast corner, rural New York. Our problem has always been not having a lot of products. So the good news here is that we had less than 1,600 people in those 6 counties enrolled. But I understand definitely the need to see this doesn't happen again, but that we are immediate in trying to address the lack of payments and how we're going to solve that for our providers, because we have enough problems in the North Country trying to attract physicians and medical professionals. I'd hate to see the rest of the state start to have the same problems we have. So thank you very much.
Thank you. Senator Boyle, who's been here, gone, back. Sorry, I didn't introduce you before.
No problem, Chairman. Thank you, Chairman Hannan and Chairman Stewart, for holding today's forum. And for all the panelists, it's good to get behind-the-scenes information about this. We've been reading about this very scary situation in the media, and to hear it today and to get some positive outlook, positive answers for creating legislation. I know we're going to have that in the coming months through the leadership of these fund members, and look forward to working with you in the coming months to do so.
Senator Rivera?
Good. Just as a means of wrapping up, I want to thank once again everyone for participating. I think we've had a very frank, candid discussion here today. I want to thank Senator Hannan with his phone, with the ringer, kept everything on schedule, actually ahead of schedule. And just some final thoughts from my perspective. Obviously, this is the first day of the session, and I would anticipate with the ramifications of this Health Republic demise are far and wide, and we need to address these issues in some way. I would agree with those that have said short-term, long-term. In the short term, as we finalize just what the assets may exist still with Health Republic in terms of covering some of the claims, vitally important that we, in my mind, that we do, for all the reasons that have been mentioned here by a number of the providers, that these claims be paid. Now, I am not a believer in adding additional taxes and assessments on health plans. We already tax health plans to the tune of, I believe it's $4.6 billion here in New York. Certainly, that within those numbers, perhaps through the budget process, we can find the money to pay the claims. The department has been reaching a number of settlements with a number of banks and certain insurance companies. My understanding is there's about $2.4 billion in settlement funds available for us to look at as well in terms of the budget process. But I would urge the administration to either in the governor's budget proposals next week or as 30-day amendments or ongoing through the process, that we look at some of these obvious funding sources to cover these claims. Very, very important that be done. Longer term, obviously, I do believe that very strongly that we need to take a close look at this prior approval process in New York, how it's working. I believe it failed us in this particular case, and we don't want to see any further problems here in New York. And so if a rate-setting process that's working, that would avoid these types of problems in the future. And that would take away the need for any kind of guarantee funds or for the state to have to step up to the plate going forward if we had health plans that are financially healthy, paying claims, and providing choices for health insurance consumers of our state. So with that, unless anyone has any further comments.
I just want to thank everybody for being here. Enormously important contributions you've made. Thank you very much.